So after breaking the 4-year streak of weekend updates, never failing to miss a day, figured it might be nice to sprinkle in some daily recaps this week ahead of the holiday season to get back in the groove of things. Let's kick things off on the SPY daily time frame chart. What do we see here from a candle structure and location point of view? Structurally, it's a little bit of an indecisive doji. It's definitely more bullish than bearish, that's for sure, with the green-bodied close, but we've got about equal parts upper wick body and lower wick, so not all that confident in the upward direction. Of course, we had that afternoon liquidation break, which we'll talk about in a moment. On the bar-to-bar count, we did produce a higher low as well as a higher high, and most meaningfully, we did close back over this inflection point at 471. So Friday's high, but also the top of the FOMC rally. We know that if we take a look at a weekly time frame chart, 471 was the previous flat top ahead of the all-time high, and also a little bit of an upper wick rejection after the all-time high. So closing back above that with today's daily bar does strike me as a nuanced yet bullish recapture of a level. Of course, from the weekly perspective, the next big target is the all-time high, closer to 479.98. Let's just put this one to bed while we're on the weekly time frame chart. If this is truly going to turn into an all-time high double top, don't fear. You really need to take out the neckline. You need to bring in some sort of lower low. Trust me, we will flip into a weekly downtrend well before the double top actually triggers. So don't let anyone scare you with that. Could we use some pullback up here? It's possible, but really on the weekly chart, as long as we can hold up over this previous weekly pivot at 459, it's also the daily balance area highs, right? Let me just zoom into the daily again here. And what you'll find is it's just the top of the balance range that we've broken out of. As long as you can hold that on weekly pullbacks, I mean, that's really, really looking good on the higher time frame charts. That would be this level right about here. So in terms of daily trend, I mean, obviously the trend is up, and we just broke to a brand new higher high with the gap up from last Thursday. And as of right now, we're trading right near those equal highs. Now, unfortunately, or maybe fortunately, this was an hourly downtrend. So that really classifies this last low from Friday as a higher low. So if we're counting trend, we have lows, higher lows flipping into the downtrend here, equal lows flipping into the downtrend here. We hadn't pulled back until these very two mild days in the downward direction. Again, just ask yourself the question here, are these large red-bodied bars aggressive sell-side pressure? Absolutely not. If anything, more indecisive, slow, controlled pullback, right? On Thursday, we actually closed back over that Wednesday high after failing into the range on what, again, was just a liquidation break in the afternoon. Again, Friday's bar did not close weak on the lows, so a very mild and controlled pullback. That's exactly what you want to see if you're really looking for momentum to continue in the upward direction. I mean, we've certainly got momentum exiting this range, going parabolic on the market over here. So the number one rule of trading a parabolic market is that you generally do not try to pick tops, right? Let the market show you the top, and then we can trade the downside once we actually flip into a daily downtrend. As of right now, we're certainly still in an uptrend, threatening an equal high break. The next target overhead should be through the upper edge of the weekly expected move, approaching 476.50, and then that all-time high from the weekly perspective, 479.98. If the market is going to reverse and reverse hard, what you want to see is this turning into a double top and therefore breaking down underneath Friday's low triggers a very nuanced double top. But as you can see, that's kind of what this looks like here. Breaking through that neckline, you should start thinking about a retest of the FOMC breakout origin. That's 465. Treat it as a zone down towards 464.25. Anything lower than that, as we discussed on the weekly chart, your line in the sand is here around 459. If this is truly going to be a successful breakout that's going to carry the market forward into the new year, you really do not want to come back down and trade inside of the range in which we've broken out of. So 459, very important level here on the daily time frame. Let's jump on down to the hourly and see what else we can learn about the movement of the market so far. The first thing that comes to mind is a pie in the sky inverted head and shoulders. Now, I know not everything has to be a pattern, but the illustration really remains. This is a downtrend, right? We have highs, lower highs, lows, lower lows, lower lows. That's why we were talking about this as acting as a daily higher low. So if that's kind of what we have here, something like looks like this, as you can see, if we continue to produce higher lows over 471, which is the weekly inflection point as well, any breaks through these equal highs should trigger a move to our next structural target, 476.50, right? So that's making sense to the upside. Any consolidation up here is healthy and it's bullish, finding an hourly higher low. And as we described from the daily perspective, right, if this is going to turn into a double top, what you want to see on the hourly is a loss under 471, flipping with a lower high here. Now, all of a sudden, you're much more concerned with that Friday low. As a matter of fact, let's throw a level on the chart together. What's that number going to be? Off by about 1 penny. You guys know the rules. Round numbers only up here at the penthouse. Let's go 468.50 as the neckline of that potential double top. Again, we are not aggressively shorting this at the highs because we believe the market will break down. We will wait for something that does this, or even better, something that does this to get us to that neckline. This is a stronger daily indication of a short, right? And we do have technically thin structure to retrace from the FOMC break in the upward direction. Let's just quickly check in with the Fibonacci's and see what these might suggest. We're going to start with the origin of the move as Thursday's low of 2 weeks ago. Remember that the market really struggled to produce a higher low over the level after gapping up here, after breaking out through it. No higher lows in the upper wick of this session here. Gap up again, failed to produce that higher low. Thursday of 2 weeks ago was really the cementing of the move in the upward direction, right? So we're going to come in from that low up to the recent high from Thursday of last week. And what you'll notice is that whoa, that's not the zoom we were looking for. What you will notice if we're zoomed appropriately is that your 38.2 is aligned with 467 flat basically, and that is an undercut of your neckline. So we would likely be in some sort of downtrend approaching that 38.2. I'm not sure I would throw all my eggs in one basket expecting that to be a major level, considering that it is not confluence with any structure from the FOMC breakout. So you could watch it if you'd like, 467, but again, it's not the strongest indication. What's a little bit better is just the fact that the 50% retracement is the origin of the breakout from the FOMC day. That's at 465. So 465 really makes the most sense as being the next big area where you want to watch for buyers to step up if there is a deeper retracement in the first place. Remember that the primary objective here on the hourly time frame chart after what we saw today should be the inverted head and shoulders consolidation up here, then looking for a breakout and follow through from the momentum in the upward direction. Quick check in with the anchored view apps, and then we'll take a look at the market internals. What do we see over here? We've recaptured. So this was an issue on the close of last week, is we technically closed underneath both the high anchored view app as well as the FOMC anchored view app, which might have suggested that the sellers had an upper edge headed into today's session. Obviously this morning, we gapped up and over both of them. So giving us a recapture just reinforces the idea that any consolidation up here is holding those anchored view apps that has to be more bullish than, of course, bearish. If we do start to see that 467 come into play, just keep an eye on whether or not that Thursday anchored view app is going to offer confluence 467. If that is the case, in a Fibonacci paired with an anchored view app, maybe you've got something going on there, but just understand that it is not relevant from a purely structural perspective. Let's jump on over to the market internals and see what these might suggest about the current price action and what we're dealing with. Volume flows today, basically nothing to write home about all day. The breadths were very lackluster, nothing impressive, and that does align with what we saw from price action, right? We saw this grind in the upward direction. That can tend to happen. We have very mild breadth readings on the internals. Then we got liquidation break into the afternoon. Was there any strong sell side pressure that actually emerged? The answer is simply no. If you look at the advanced decline line pegged to the zero line as well, much more indicative of balance, neutrality. Same thing with the cumulative tick. I mean, it was flat all morning, then finally moving a little bit lower as the consolidation was taking place. One of the things we talked about in the chat today was, hey, watch out for the fake break up and over this high. Liquidation break is a concern underneath 94 over in the ES, and lo and behold, we did end up closing underneath that. So as of right now, with the liquidation in place, is it possible that the highest probability outcome for tomorrow is looking for a balance here and then taking it day by day, even hour by hour, waiting for a higher low over 473.25 to trigger the breakout, waiting for some sort of breakdown here? You can trade it short, but just understand that there really isn't a larger seller out there, at least reflected in the market internals. I would really want to see a stronger daily breakdown underneath what could be a double top neckline, which, as we know, is 468.50. Changing gears to the QQQ daily time frame chart, what do we see here from a candle structure and location point of view? Certainly solid green-bodied bar, and on the bar-to-bar count, a higher low paired with a beautiful higher high, breaking out up and over the two equal highs from the Thursday, Friday of last week. That's different, of course, to what we just saw over on the S&P 500. We're really just a stone's throw away from the all-time high. We missed it by a couple of ticks at the highs of today's session. 408.71 is the level. Then we're looking for blue sky territories, basically $0.50, any intraday levels that form. As long as we're looking for daily consolidation over that 406.25, continuation is the name of the game here. If there is going to be an aggressive pullback, you could technically start thinking about this. Let's actually go on down to the hourly chart. I think it's more constructive to talk about the nuanced patterns over here, especially as we head into the remainder of this week. If we're looking at the hourly chart, right, if this is a two-day high breakout, this is perfect for continuation. If we fall back down into this area in here with a lower high, starts to trigger a head and shoulders. Now, underneath the low of Friday's session, direction is where there's actually a trade that unfolds. I would not try to short the market here on a lower high under the 406.25, but rather through the neckline, which is at 404.25. So if there is going to be a pullback, and again, there's nothing about the daily chart that would suggest that yet, if there's going to be a pullback, the stronger short is actually looking for your lower high and then thin structural retracement over here back down to the origin of the FOMC breakout. And that level is going to be at $400.15. If we just go back to the daily chart for a moment here, the larger retest that would be the equivalent of your SPY 459 is this level at 392.75 on your QQQ daily, right? Ideally, the daily higher low is found here based on that reversal we just covered from the hourly, right? You're looking for an hourly trend reversal when you get there, double bottom, inverted head and shoulders, the whole 9 yards, even just a simple daily hammer candle down here that offers up a clean place to manage risk. You're trading over that high back up to the equal high. This is a daily higher low. You could still get a weekly higher low, right? If you're looking for the retest over here. The only issue with these deeper pullbacks, so the same thing holds true for SPY 459, right? Say that you do move all the way to this area. The issue is that you have to now battle back up through the FOMC consolidation and kind of that second leg higher after the break from this balance range over here, right? The threat is just a lower high. And if this turns into a larger weekly double top, daily double top, then you're underneath the neckline back into the place where we were consolidating before the breakout. That's again much more of your larger red flag, very similar to what we discussed over on the SPY itself. So for the most part, again, buyers remain in control as long as we're getting this consolidation, looking for that follow through higher. Just to be congruent, let's go ahead and take a look through the lens of the Fibonacci and then of course the anchored VWAP here for our QQQ as well. Using that same Thursday first higher low as the anchoring point for all of this. Notice that your 38.2 over in the NASDAQ QQQ is more so aligned with that $400.15 mark, which is structural as well, coming from the FOMC breakout, right? So that makes a lot of sense to me from that point of view. Let's take a look through the anchored VWAPs intraday, and what we'll notice here is, again, this is why to me, even if we fall back down into this and there's even a lower high in there, I wouldn't be a short as you're getting tangled up around these anchored VWAPs, really clearing that for, there's your head and shoulders, whatever, if there's going to be a reversal, getting underneath both of them, like breaking down through them with a lower high rejection underneath, that's the cleaner trade to the downside. So be patient if you're looking for a stronger rejection of this market. Remember that trading a parabolic market, you usually don't want to be trying to step in front of a moving freight train, especially when we're this close to all-time highs. It would seem, not for nothing, but it would seem almost inappropriate of the market to come this close to the all-time high, reject it, and then rotate strongly in the downward direction. Generally speaking, when you're this close, you do not want to see two things. Number one is missing it by just a couple of ticks. The other thing would be a move through the all-time high in the after-hours session, opening up regular trading hours session underneath and then falling away. That would be the improper end of a pivot or swing high. So I would carry forward that there's a weak test in the overnight. We haven't seen that yet, but it's something to be thinking about as we're close to this area here at 408.71. Let's go on over to the market internals for the NASDAQ side of things. And what we'll find is that it's actually incredibly similar to what we had over in the S&P. Let's go ahead and ditch this one over here and we will take a closer look. So flat around the zero line from a volume flows perspective. Net flows on the week, I've hardly done anything, obviously. In terms of the advanced decliner, a little bit more bearish over here on the NASDAQ. Even though we broke through the two-day highs, we're underneath the zero line out of your ADD. So watching that quite closely as maybe an indication that we want to look for consolidation before continuation, just because there's not exchange level support for the move that we saw higher today. Same thing over here out of the cumulative build for the NASDAQ, a little bit more bearish and sustained bearish even earlier on in the day as compared to your NYSE side of things. So what does this all really come together to illustrate for the NASDAQ? It would really show me that I would prefer to see retest higher lows over the two-day highs for another setup in the upward direction and not just blindly chasing longs near these highs because we're so close to the all-time high. A situation I could imagine is some sort of test through the all-time high on still somewhat crummy or even neutral internals and then coming back in for a little bit of a pullback. If the internals stay this way, if they don't really perk up and align with any stronger moves in the upward direction, that's one possible back pocket situation to have for the week. Last but not least, we've got the IWM Russell 2000 and the small caps on a weekly time frame chart for very apparent reasons. Obviously, this as a weekly or even monthly balance range is in force as we aggressively approach the top of the range. We have a wall-to-wall move is what we call this when we move straight from the bottom to the top without any major pullbacks along the way. Notice that over here you have lows. This kind of pulls back to find a higher low. Then we approach the top. This time, there was no stopping, right? Sure, we got this little 3-bar play breakout in the upward direction, direction, but for the most part, it's been nothing but momentum from the bottom to the top. I think that this is a record-breaking time duration for the Russell to make a 52-week low and then a brand new 52-week high. So very impressive stuff. But again, is it reasonable that a pullback could unfold up here? Yeah, if the sellers are going to be waiting anywhere, it's certainly at the top of the monthly balance range, and that level's close to 199 and 200. As a matter of fact, let's just take it on down to a daily time frame chart so we can understand that we're stuck in a little bit of a balance range. First and foremost, before we crop into this upper price action, this is an uptrend. We have lows, higher lows, higher lows, higher lows. Along the way, highs, higher highs, higher highs, just broke to a big time brand new higher high. There's much more of a meaningful gap up from the Thursday session last week after the FOMC break in the upward direction. That's definitely more bullish than bearish over here in small caps. But what it's done ultimately is produced a little bit of a balance range, right? We have a 2-day balance up here today, was certainly contained within the balance. So it's a very simple chart to be thinking about up here. If we break the balance highs, 199, higher lows above, you're going to target 201.25, and then anything beyond the upper edge of the weekly expected move is at 204.35. Could we get there? Certainly possible. The small caps are very sensitive to economic data, and clearly they've been violating the upper and lower edge of weekly expected moves over the past couple of months as we've been going through this violent sort of reversal off the lows from October, right? So upper edge 199. If we do something like this, looking for continuation in the upward direction, there's certainly momentum. We know that we have a strong trend underneath us. If it's going to be down, don't be thinking about a weekly like, oh my God, Armageddon sell. It's the end of the world. Small caps are going to, crash and burn. Absolutely not. A breakdown underneath the bottom of the 3-day balance up here at 196.50 would actually be welcome. Repair some of the thin structure underneath us and then look for a daily higher low. I mean, the last higher low set is over here. There's plenty of places to look for that higher low. The first pit stop for me would be 193.60 gap close reversal. Anything underneath that, let's say that we just blast right through it, it's still okay. You can find a daily higher low here at 187.75. That would be something like a 2 sigma move in the downward direction, right? If this is 1 sigma, about 2 sigma move in the downward direction there. Not unreasonable, but you're still technically in a daily uptrend as long as we find buyers here. So don't overcomplicate your IWM chart. As a matter of fact, we're going to take it on down to the hourly before we start talking in circles about it. And this is just the same thing, right? So sure, a little bit of a bearish benefit of the doubt today, closing underneath the opening print near the lows of the overall range. You could start to classify this as a descending triangle. It's there, but give it some context, right? There's a bull pennant if you just add on the pole. So breaking down into the gap, we already know what we're talking about there. We already know what we're talking about up here. The last thing I would say about the IWM is just use this as a gauge for market strength, right? If the IWM is going to break down into this gap, then you probably shouldn't be thinking about SPY new all-time highs if the QQQ is also breaking down. If the QQQ is taken off like a rocket ship over the all-time highs, blue sky territories, just total ripper to the upside, then less concerned with the IWM closing this gap because we know it's still bullish technically from a structural perspective here at 193.60. Now, if the IWM starts to rally in the upward direction, of course, more confidence that this is, just total momentum domination from the buyers. QQQs would likely be moving higher as well to those blue sky territories. Much more confidence for your S&P continuing in the upward direction, scratching out those all-time highs we had just discussed. Let's jump on over to the Russell internals just to round out our look here at the different components. Then we'll jump into some sectors. Mildly down in terms of breadth, nothing crazy there. Again, not Armageddon style selling, just a cooling off, if you will. Totally reasonable considering that we were stuck inside of a balance range here. So nothing to write home about. No big takeaways from the internals out of the Russell. The sector distribution as we kick off this week does start to look more bullish than bearish. If we're thinking about risk on versus risk off, XLC leads the pack. That's definitely more of a heavier weight risk on style sector. XLP is up here and that's D for defensive, but look what's just underneath. It's the XLK, XLY leading the pack here as green names on the board. At the bottom of the barrel, it's the energy sector. We know that demand for oil still kind of slacking over there. Some small issues with that chart, which we'll get into in a moment. But then it's all the rate sensitive stuff like real estate, materials, utilities, all that stuff is at the bottom of the barrel. So as we're breaking out specifically in the QQQ, as the SPY tries to recapture that Wednesday and Friday high of day from last week, it does strike me as more bullish than bearish. Let's just quickly check in on the structure. The XLC is already loaded up here, breaking out up and over this previous top. To me, again, very bullish. Nothing really wrong to say about this chart. Consolidation that continues over 71.25 looks good. Even if we do pull back, you can find yourself a daily higher low up and over 69.90. So not concerned with the structure over here. XLP, what has it done? I mean, it's retraced the big downdraft that we saw in the month of October, and now it's just putting in a rejection. It's unwound all of the FOMC move, and we've just scratched back in the upward direction over 71. So does it really deserve to be at the top of the list over here? I'm not really convinced that it does, and again, that's why we're not concerned about a risk-off rotation currently. Here's the XLK. I mean, all-time highs are where we're trading. Does this chart look bullish? Does it look bearish? Certainly more bullish than bearish. Any pullbacks, even on a daily time frame chart, find a higher low over 186.35. Not concerned with the structure there. XLY, similar commentary over here. Big break, gap and go on the Thursday and Friday of last week. Certainly can give a gap fill reversal. Consolidation over this looks bullish. I mean, even a pullback here is welcome, right? You could technically pull back into 175, look for a daily high or low, and then continue on your merry way. If we just grind in the upward direction, 182 is the next level to be paying attention to. Here's energy, and although it did recover right to the top of this previous range, it backed off aggressively, and it's still rejecting the daily 50 SMA there. And we know that from an energy perspective, if we're thinking about crude in particular and what that means for global demand, it's not really great to see this lagging so much. We don't want it leading the pack because it's such a lightweight sector, but global demand for oil being down is not necessarily indicative of economic expansion, so to speak. So a minor data point, but it's so minor in the face of an XLK that's making a new all-time high. Let's check in on the SMH while we're talking about tech stuff, as a matter of fact. And what do we see over here? I mean, it's the same exact chart, basically, breaking to a higher high on the Friday session of last week. Hammer candle on today's session, certainly available to find a higher low over the prior all-time high. Again, that oil data point is just such a minor data point in the face of these charts that are clearly illustrating that the risk on side of the trade is the favored outcome as of right now. Here's the real estate sector. Remember that this was a very tricky range from in the past. The market seemed to have no issue ripping straight up through it. And as we know, that's because of the sensitivity to interest rates. Interest rates have been dropping like a rock. We'll take a look at the TNX in just a moment. Materials, same idea. It went from one of the laggards way down here on the lows to instantly retracing almost all of the move, trading back up towards the highs of the overall range, if you will, from like a monthly time frame chart. So any consolidation up here is bullish. Again, pullbacks are fine. Remember that if lighter weight sectors, specifically the XLB, the lightest weight sector, is really going to have a negative impact on the market, it needs to be making a big new pivot low, which would require something underneath this previous pullback here at 81.35. I mean, if this happens and we get a look that's somewhere along these lines, yeah, we've got some issues. But as of right now, it seems like a lower probability outcome, really looking for that higher low to persist. XLU, similar commentary to the XLP, right? Honestly, the entire FOMC rally has been unwound. We're back down towards those lows. It's not leading, so we don't have a leadership issue. It's upward pressure. Don't get me wrong; it's still upward pressure. Looks fine. I'm not really seeing a concern from that point of view. XLI, industrials, new all-time highs. Again, is this bullish? Is this bearish? Just ask yourself that question. Obviously, most things are more bullish than bearish. Here's the XLV, D for defensive, but second heaviest weighted sector. It's pulling back, but I mean, compare this look to something like your XLU or your XLP, which are also D for defensive sectors. Both of those have already unwound the entire FOMC move. Now, don't get me wrong, we're certainly lower in the XLV, but we're not at the origin of Wednesday of last week's open, right? Definitely not. And as a matter of fact, we're starting to get some lower wicks trying to show up here. It doesn't mean that we need to reverse, but the buyers are trying to step up. The main illustration is that, yes, although this is D for defensive, it's not leading, we don't want it falling off of a cliff, and it's certainly not falling off of a cliff with those lower wicks, an indication that buyers are trying to step up and produce a higher low here on the daily chart for the healthcare sector. Last but not least, our financials. And I don't know about you, but again, does this chart look bullish? Does it look bearish? This is certainly a ripper of an upside move, consolidation for just a little bit, and a continuation move. I would understand some skepticism about financials, just understanding that obviously financials benefit from a higher rate environment. So why, under the guise of rate cuts, would financials break out here? That would sort of be a bit of a head scratcher. I just think it's an easier operating environment. Think about the money that banks will originate or generate from the loan origination side of things as interest rates come down. More people want to refinance, more people want to buy houses, right? And obviously financials play a role in that and collect fees in the meantime. So not a perfect one-to-one relationship with lower rates implying downside pressure for financials. It's just one thing to be thinking about here. Let's take a quick tour through some ratios. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner on how to set this one up. The XLK is certainly going sideways in this box overhead, but it's well above an upward sloping 50 SMA. So this still does strike me as a risk-on indication, but look at the follow-up from the financial sector, making a big higher high here, making a big higher high over here. We're pulling back a little bit, but overall, this is a big improvement for the risk-on look. Same thing over here in the XLY, rallying to a downward sloping 50 SMA and then going sideways isn't always the best look, right? It's possible possible that this just turns into a lower high, but as you can clearly see, and as the market has exhibited, we have broken to a big time higher high. That is a risk on indication. Here's the healthcare sector rotating in the downward direction, not exhibiting any relative strength. And once again, that is a bullish indication. It's the second heaviest weighted sector, but we also don't want it outperforming the S&P from a risk on risk off perspective. Here's the XLC trying to perk up. If this turns into a double bottom, that would add into the constructive look for the risk on narrative here. XLP falling off of a cliff, XLU falling off of a cliff, energy kind of sideways and flat down here. Real estate obviously perking up because of the sensitivity to rates. Overall, certainly looks like a, certainly risk on indications across the ratios that we're watching. Same thing here, XLK over the SHY. This is basically comparing the most risk on asset tech stocks to the most defensive asset short-term government bonds, basically. So there's definitely an appetite for risk. Nobody's flocking to safety anymore like they were in this potential indication over here. So that is a bullish one. If we take a look at the XLK over the XLU, dialing up the sort of risk a little bit on the second half of the equation here with utilities instead of government-backed bonds. So you're still looking for some sort of yield out of utilities, but still a preference for risk on tech stocks, breaking to a higher high on today's session. Last but not least, certainly apples to apples is the XLY over the XLP. This has been the most constructive look we've seen in a long time, a couple of months for this particular relationship. Notice all the fake breaks as this consolidation is taking place. We finally have a bit of a definitive move from that range. And once again, this is a bullish looking chart. Let's take a look at what's happening with the dollar. Anything interesting over here? It remains weak. This is certainly a big time weekly lower high. We've broken to a lower low, just meaning that we can afford another lower high. So even if the dollar rallies, it's not really going to act as a major headwind for equities as long as we produce that lower high. So watching 103.50 if there is any sort of upside retracement over here. Let's check in with the metals just because they give us some sort of insight to the dollar. The GC contract is up first. Look at the beautiful higher low here, bouncing off of the breakout point from 1, 2, 3. This would be fourth as now support at 2,000. Makes a lot of sense that the dollar is moving lower as gold is moving higher like that. We could also check in on silver. We know that silver has sort of led gold over the past couple of weeks here. One issue I have with silver is just the fact that if you do something, so first and foremost, this was kind of your all-time high rejection. Boom, right? And then if you look at this as well, there's a larger undercut of that in silver, whereas gold held that 2,000, right? That would be the equivalent. So seeing silver undercut doesn't give me a warm and fuzzy feeling inside, but it is technically a higher low still. You would like to see this obviously hold above this level now, which is, let me give you the number, closer to 2380s. 2380s in silver wants to hold to continue to be a bullish force for gold and thus a bearish pressure for the dollar. Loosely related. The correlation is not exactly one-to-one, but you get the idea that alleviates downward pressure for the market here. So far, so good. Equities paired with the dollar and metals does look like a bullish relationship so far, or as we continue, I should say here. Interest rates through the lens of the TNX, again, absolutely falling off of a cliff. Everybody was watching 4% as like sort of a round number, which makes sense. Again, 4% being a round number is, it's human, it's psychological, but more importantly, from a technical perspective, this lower high here underneath 43.33 is kind of the nail in the coffin, and obviously we've rotated in the downward direction. Now, some folks are sort of looking at this as like, oh my God, why are people, because what this means ultimately is more people, there's more demand for something. Let's take a look at the ZN, right, from a notes perspective. It's like, why are people flocking into bonds so aggressively? And we'll also see this through the lens of the TLT, actually. Let's just do this now. Let's have this discussion in real time. Like, why is the TLT outperforming? I thought this was a risk-on period for the market. It is a risk-on period for the market, but think about the gift of higher rates, right? If you think that rates have ultimately peaked and you're running a long-term portfolio for a client or, let's say a pension fund, a retirement fund, whatever, of course you would want to lock in higher rates. And if you think rates have peaked, then you better be buying TLT. You better be buying bonds, right? And lock in that sort of yield for the duration that you want. And that's kind of, in my eyes, why this, sure, there's some relative strength to the broad market. You can see the minor break of the resistance trend line. It's not ripping to the upside. This has not gone parabolic, though, over in the TLT. So in my eyes, it's people chasing yield, wanting to lock that in, not necessarily a flight to safety style trade. And I think we can support this claim if we look at other, sort of provide some context around what's happening with bonds. So these are short-dated bonds versus slightly longer-dated bonds, and they're clearly moving in the downward direction. And this would just illustrate a preference for, all right, we want something with some time on it now. We're not flocking into short-dated assets because we're scared, we're skeptical of what the market's doing. So as of right now, this checks out as supporting that theory. The other thing that really aligns with this quite nicely is credit spreads, tightening dramatically. You'll notice how aggressively these have come in over the past couple of weeks. And again, what that would illustrate is great. We're ready to take risk over in corporate stuff instead of government-backed, quote, risk-free assets. So again, appetite for risk remains elevated. And I think it makes a lot of sense with the breakout that we've seen thus far. I know we didn't cover all this stuff on Sunday, but we're doing it now. And, it's totally in alignment with the breakout we saw from the FOMC, the continuation move we're starting to see today. Here's the HYG. It didn't really get in gear as strongly as your equities market. Is it possible that this is cooling off a little bit? It is possible. We know that there's a longer term catch-up game that's being played over here. If we just put these to 1 year charts, remember that this is a balance range in your HYG. It's just barely broken out. That balance range is the equivalent of what we had over here in your S&P equities. So, I mean, we're getting there. We're getting closer. We're definitely over, similar inflection points. Here is a high, right? Higher high, same thing, higher high. So it's getting very close. And in the short duration, like back down to the hourly chart, maybe there's a little bit of an indication that, hey, we don't really have that higher high, maybe dial back expectations of big time continuation. Or if you're trying to trade longs in the S&P and you notice that the HYG is near those highs, all it takes is a break here and it's rock and roll for your equities market down below. So just monitoring these relationships as they continue to progress. Bitcoin obviously holding that breakout from a couple of weeks ago here. This is a weekly chart. So there's that break of the bull flag. The pullback last week is very, very mild. You can see a lower wick there. This is a risk on indication, although it's not one-to-one with financial assets, traditional financial assets like equities, bonds, so on and so forth. So here's the new highs versus lows. Let's dive into some market breadth now. This has continued to improve up and over the zero line. Remember, the more time we spend over the zero line, the better. We don't necessarily need this like blockbuster style read up around 500. It would be nice, but remember that the early stages of a rally can certainly be met. This is actually more appropriately aligned with this, right? It's the sickness recovery, if you will. That can be met with, you don't need big reads is basically what I'm getting at. The longer you can stay positive, the better, because it's just an indication that, hey, things aren't falling off of a cliff. Things are not deteriorating, right? So far, so good in terms of breadth. It's really played nicely with the breakout we saw from FOMC. Here is the SPX A200R stocks trading over the 200 SMA. Big uptick on the FOMC week last week's, currently trading higher on the Monday session here. That does strike me as bullish and in alignment with continuation thus far. Here's the SPX A50R, just grinding into contrarian zone. I would understand if that you're slightly skeptical, you're looking for a market reversal because of this one, but remember, this is one data point, just like when we talked about crude and demand for energy is one data point. So far in all of the charts that we've covered, you have two data points that align with maybe there's a pullback, maybe things aren't that great, but everything else is totally aligned with the bullish thesis so far. Let's take a look at the RSP equal weight. This continues to this is amazing, really. I'm almost disappointed in myself for not putting out the video over the weekend because of how impressive this move was. It finally took out the top of the range, right? This has done so a long time ago, and you can see here on the RSP equal weight, we've also broken into a brand new higher high that does strike me as a bullish catch-up play. Same thing over here in the QQQE equal weight NASDAQ 100, breaking in the NASDAQ and breaking in the equal weight over here. That's all fine and dandy from a relative strength and just sort of breadth perspective, if you will, right? If we're looking at industrials, big all-time highs out of Dow Industrials, and transports are playing nicely. There actually was a beautiful constructive hold. If you're thinking about stair steps, right? Higher lows, higher lows, higher lows, break through and higher highs into the end of last week. I was a little bit nervous, if I'm being quite honest with you, as the FOMC was unfolding, only able to produce that equal high, maybe a slightly higher high breakout. I was thinking, you know what, leave it to transports to produce the double top, break that neckline, and then it's like Armageddon sell. Like, oh, no, dial it back in the industrials, right? But so far, so good. Transports finally played catch up here with that break up and over 15.7. So everything that we have from a breadth perspective, aside from the contrarian indication, the SPX A50R, aligns with the breakout continuing based on what we can see here, right? This is a bullish breakout. Nothing is overly divergent. So far, you should be trusting the market move in the upward direction. Let's take a look at the VIX and see what's going on over here. So far, this is floored, and that should, no surprises over there in the VIX. If we take a look at the VVIX, this is perking up a little bit, but in my eyes, that was really the quad witching, right? The quad witching on Friday is more so what caused this to tick higher. Today, it's slightly lower, and even at that, we're not even close to that sort of precursor break zone, which is 103. As long as we're like low in this overall range here, it's actually a much more comfortable place for the VVIX as opposed to 75. When we're down here, the complacency effect takes hold, and all of a sudden, the slightest little volatility indication kicks this thing up, and all of a sudden, we have a bigger issue on our hands in the equities market. Here's the VIX futures. And you can see these continue to drift into an aggressive contango, just speaking to less risk in the present day than there is in some unknowable future. And I think we can also look at the depth. Remember, we've been commenting on the depth of the inversion here. You can also see this through the lens of something like your skew. Your skew last week, certainly coming down today on the Monday session to kick off this week, but last week it printed a higher high over the top, or maybe just an equal high to the top of this range. Remember, that skew it's only important when it's on the lows. It's when everybody is like, okay, fine, things are not going to end, the world's not going to end. When everybody's betting that the world's going to end, everybody has insurance, right? And everybody basically is saying, we think the market's going to crash, but we don't know for sure. So this is not a strong indication to short the market just because skew is elevated. It usually does not yield in a big down move for the market. I think other than the sickness plunge over here, that's the only one that kind of aligns with a big time move. Oftentimes it happens after, as a matter of fact, right? So if I just do something like this to, let's just auto zoom this just so you can understand what I'm talking about, right? Oh, look at that. I was off on my own. So good thing I did that, right? So you can see elevated skew does not necessarily correlate with a direct market crash. You can see the market continued before pulling back through the duration of 2022, as we know, a very painful year for the market there. So that's what we've got from a vol perspective. Let's jump on over to the core list of companies now. We're just going to keep this thing rolling and just jump right through them. Really, getting back in the saddle here, missing the weekend update. I'm sorry about that. I've got to do it for my own good. It's my own habitual ritual, if you will. Got to do these things. So what do we see out of Apple? Hammer candle on the daily, breaking to a new all-time high wouldn't be unreasonable. Is this a daily high or low? It certainly looks possible, holding that 195. Remember, we talked about this in the pre-market prep, even holding the top of this breakdown bar over here. This is the origin of where things got really nasty, right? Really nasty from the highs of the summer. So to see that holding now as a potential area of support after what was previous resistance over here on the first test looks pretty constructive out of Apple. If we take it on down to the hourly time frame chart, what you want to see here is you've even got like an hourly cup and handle. Look at that. So if you can break over this, and really it's just a recapture and a higher low over 196.75, I think it's game back on to the upside and you're searching for that all-time high. If this continues to consolidate down here, that's a different story. If there's no break, then okay, we have to give the sellers the benefit of the doubt. This is a building block in the downward direction. Then your next slip is under 195, turns into something that looks like this, trade through the thin structure retracement, and we will look to target 193.25. The other thing I could potentially see here, now that I'm just talking out loud about it, is if this turns into a double top or double bottom, you wouldn't be a buyer here per se because you're coming off of a lower high from here to here. But if it turns into a double bottom and you clear that neckline, you could still withstand a pullback first, equal low, and then a higher low here still gets you in gear in the upward direction. Next up is Microsoft. What's going on with Softy? Totally range bound. So keep this one simple. We're not even going to look at a daily time frame chart. You're looking for over 373.50, under 368.25. As of right now, after today's session, I'd be more partial to a higher low inside of the range. Remember that this was look below and fail. Here's a higher low in the range here at 368.25. I'd be looking for another one of those basically and say, okay, if we can test the top again, it's only a matter of time before someone opens that door. Remember, you knock once, you knock twice, 3 times, 4 times, someone will open eventually. 373.50 seems to be the level of importance there. Google, what do we see out of Google? Big move on Google today, totally ripping out of this as a balance. Again, here is sort of inverted head and shoulders. Here is your look below and fail on the balance range, if you will. So I've had a target, here. Google was like, nope, we're going to triple that on today's session. So be it. You win some, you lose some, you miss some, you leave some on the table. It's fine as long as you execute according to your principles. So looking forward now, obviously what we want to see is any higher lows outside of and above 134. If Google can hold up on pullbacks over 134, continuing to trade this in the upward direction, I would say you could also look for this here. Any consolidation over that 135.30, let's say. You guys know the rules, round numbers only. We did this in the earlier segment of today's video. We'll just go with 30. That works for now. And we'll zoom back in. Any consolidation up here keeps these buyers content. If we break down underneath, that's where you get your pullback because this turns into overhead supply, right? You have disappointed buyers who are like, okay, I was late to the party. Let's close out. Let's look for a better entry. That provides this sell side pressure when we get here. You guys know the name of the game. Looking for double bottoms, inverted head and shoulders, the whole 9 yards at 134. Continuation in the upward direction. Our next overhead target is 139. One day, one step at a time. Consolidation and then a break, or pullback higher low and then a break, right? Next up, Amazon. Amazon. This is also a range-bound beauty that finally started to rip on today's session. This was a top watch this morning over 150. Beautiful move. Couldn't ask for more out of Amazon. Here it is on the daily time frame chart. I think it makes more sense on the daily, right? If this is your balance range, you're getting consecutive higher lows, higher lows even here as we're consolidating over the top of the balance at 147.60, excuse me. And today was day 2 follow through, right? Obviously on Friday of last week, you trade for the 2 equal highs. You open on a very minor gap up this morning, hold that level and absolutely rip. So I think for the most part, we're home. If we're thinking about a range double, we've basically done it. We've traded towards that 155. So I wouldn't be a new money long out of Amazon after what we saw today. I would be thinking about what's the next setup here. Can we get a pullback? Can we get something that does this? Set up the same exact move for continuation, but pull back first. If it continues to drift in the upward direction, as long as you can pick off a stop loss intraday, maybe you've got something going on, but there's really no structure that was revealed intraday that you would be paying attention to. Maybe something like this, right? Consolidation here is an hourly bull flag and then a break and a higher low over the previous high of day makes some sense for a possible area to look for an entry because your risk is defined, right underneath that area. Next up is going to be NVIDIA. What's going on with NVDA? Another breaker, if you will, in the upward direction, playing nicely over the high of that Friday session. So everything considered here is looking more bullish than bearish. We're very close to that all-time high. Again, just think about this from a weekly perspective. This is going to be your double top. You got to be underneath the neckline, which would be way down here, not in play. Same commentary as what we discussed over on the S&P, right? As of right now, holding over the high break from the morning session, right, into the afternoon here, $500.75, consolidation above, looking for a continuation. If you slip underneath, maybe a very nuanced hourly head and shoulders, maybe it's even like a 15-minute head and shoulders or something like that, I would look through your neckline to retrace the thin structure. A daily higher low could certainly be found on a retest of 492.50. Next up, we've got Metaverse. What's going on with Zuckerberg's Fantasyland? Another ripper in the upward direction, right? So all the mega cap tech, the Magnificent Seven, are playing nicely here. Consolidation higher lows over 342 continue to make this look magnificent. Speaking of the Magnificent Seven, right? A retest over these highs, looking good. Follow through up and over 347.50. Your next target's 353.25. If we slip this with a lower high of thin structure to retrace, that could be a short, but just because we have the thin structure retracement, right? When we get to 337.25, what are we thinking about, right? Reversals, double bottoms, inverted head and shoulders, hourly hammer candles, the whole 9 yards at 337.25. It's a top watch if we see a stronger pullback. Next up, Tesla. What's going on with Mr. Musk and the rocket company? It's been a little while since I've said that one. A failure to hold this breakout level into the close. So the morning pop was great, but unlike all of the other sort of mega cap stocks that we've covered today, this did not hold. It actually produced a nasty, if you look at the daily bar, right? It's a nasty inverted hammer off of a previous area of resistance. So is it possible that Tesla breaks down and pulls back? Absolutely. The first place I would be thinking about, so the setup here is short underneath these lows, today's low of day basically, for a retest of the top of the balance range. This is a daily balance range, and there should be some sort of fight that happens at 246.25. I'd be thinking about that for a possible higher low on the daily. But, as of right now, not a confident break whatsoever on Tesla during the morning session, giving up so much of that move and closing red on the day's session, even underneath that breakout point, right? So thinking about Tesla pullbacks here, if you want to be a pattern player, you could, of course, look for something like this. There's your head and shoulders. To me, just a lower high underneath 253.30 kicks off that move to retrace into 246.25 when we get here. You guys know the name of the game. Not even going to repeat it. Next up, last but certainly not least, is Netflix moving into the big overhead gap. As a matter of fact, let's do it justice and put it on the daily time frame chart. This is your overhead gap. This is a monster of a trend in the upward direction here. We got some pullback. It was not as orderly as I would have hoped, and the retracement out of it was not as orderly as I would have hoped, but we have some very clear indications as to how to get involved near this overhead gap. So let's take it down to the hourly. I think you can probably know exactly what I'm going to say. Any consolidation over that 481.75, trading this in the upward direction for the gap close. I mean, we've got some room to run here. Remember, you do not need to be the first one in the door when the gap is this large. So maintaining and watching for this to hold confidently as a higher low is not a bad idea. Equal high breaks continue to move through the virtually zero structure because this is a gap, and the target's 506.60. Not saying that we get there all in one fell swoop, but so far looking pretty darn good with that beautiful retracement holding over the previous highs over here. If this is going to turn into a double top, again, what you will notice is a failure of those lows to hold, and you will be looking for shorts underneath 481.75. So the inflection point here is is clear as day. 481.75, 481.75, 481.75 is the name of the game. No additional trade ideas today. We're going to leave that maybe for tomorrow's episode. We won't do the full run through tomorrow. We'll keep it a little bit briefer and try to, again, do some daily updates in lieu of missing the weekend update. Hopefully you enjoyed this episode. If you did, let me know down below in the comments section or by giving the video a very simple thumbs up. I appreciate that very much. And with that said, we will see you in tomorrow's pre-market prep, and I wish you a green trading week.